Hello everyone. If you are new to the channel, welcome, otherwise welcome back. In this video, we are going to cover another aspect of the financial world, the derivative. I will try and go over various aspects relating to this topic. It will not be a complete guide, but by the end of the video, you hopefully will have a more rounded idea of what they are and how they operate. So let's get into it. Before we touch on a few well-known types of derivative contract, it would be prudent to go over the trading infrastructure on where they are traded. In my last video, I touched on how instruments, also known as stocks or equities, are traded via exchanges or privately between institutions. Please watch that video to gain a better understanding of how they work. For derivative contracts, this is much the same. Derivative exchanges work in much of the same way as equity exchanges and are generally known as a futures exchange by general terminology. The name of futures exchange is somewhat misleading as these exchanges trade all types of derivative contract, not only futures contracts. Over time, many of the individual derivative exchanges have merged into much larger entities and their names are now that of their parent exchange. But they may still exist as markets within that exchange. Some examples for these futures exchanges are the CME Group, also known as the Chicago Mercantile Exchange, the Intercontinental Exchange known as ICE, Eurex, the National Stock Exchange of India, Hong Kong exchanges and clearing. These exchanges all have defined contracts which counterparties from all over the world can engage in trading. The derivative name comes from the nature of the contract being derived from an underlying asset. In that, it is tied monetarily to another asset. This can be almost anything, from gold or other precious and non-precious metals, oil, wheat, which are known generally as commodities. Derivatives can also be made from other financial securities such as instruments, indexes, or currency exchange rates, also known as the foreign exchange or FX rates. So now we know where derivative contracts are traded and what they are linked to. Let's take a look at some specific contract types. Futures and forwards. A future is a standardized exchange-traded contract in which the two counterparties will settle the contract at a predetermined date at a determined price. Each contract will be given a contract code which will be unique to that particular type of contract. This allows trading platforms to identify the different contracts on the exchange. Each contract is also given a letter to denote the month in which it matures. They are also given a year value. This can be a single or double-digit value. Single-digit codes will be from 0 to 9 and allow traders to buy contracts up to 10 years. Double-digit codes will allow traders to purchase contracts up to the next 100 years. Codes for a single contract can differ greatly, depending on the vendor being used to source market data. Futures contracts mature or expire generally at the end of the specified month and should be settled at this time. There are several contracts which may have daily, weekly, or even rolling maturities from the date of trade. The London Metal Exchange has a set of 3-month contracts which mature 3 months from date of purchase. Futures can be useful to both counterparties, as both can lock in the price for goods which are then unaffected by market fluctuations. A widely used example of this is a bread maker and wheat seller. Both parties can ensure with the use of a futures contract that the underlying price of wheat will not affect their margins from the date of the transaction to the maturity of the contract. It also ensures the baker has a supply of wheat. This moves to another aspect of a futures contract. They can be physically settled. The farmer will deliver the specified wheat to the baker. Or cash settled, the farmer will pay the difference in price between the futures contract and the current price of wheat. The cash settled example doesn't work well in the world of baking, as the baker still needs to acquire some wheat for their bread. However, using financial institutions speculating on the price of wheat as an example, cash is preferred over taking delivery of 5,000 bushels of wheat. Cash settled contracts make up the majority of contracts traded on many exchanges. Physical delivery contracts have very specific delivery requirements set by the exchange, and thus are only valid for a small selection of companies who can adhere to these requirements. Forwards are similar contracts to futures, however they are not exchange standardized and traded OTC. This allows them to be tailored to the requirements of both parties. Futures, as they are exchange traded, will be subject to margin requirements. Forwards are not. Options and warrants. The option, like the future, can be a standardized contract in which the two counterparties will settle the contract at a predetermined date at a determined price, also known as the strike price. This strike price is not the price of the option contract, but the underlying asset. This differs from the future contract, where the price of contract is the complete cost of the underlying. Options, however, unlike the future, which carries with it the obligation of the holder, that at maturity the transaction will take place, the option allows the holder the obligation of not to settle the contract. If the holder decides the option does not benefit them financially, then they can allow it to expire, with only the option contract premium being lost. There are two main types of option styles. American, these can be exercised at any time before or on the expiration date. European, these can be exercised only on the expiration date. These are called vanilla options. Other styles have names such as Bermudan, Asian, barrier, binary, and exotic, all with various criteria associated with them. We may cover these in more depth in another video. As with futures contracts, each option is given a ticker, along with a character and numerical maturity identifier to allow users to quick determine the option and its maturity or expiration details. Each exchange will determine the exact expiration date for each contract. This usually is the third Saturday of every month, or the Friday before the third Saturday of every month, for American and European styles respectively, as an option can carry certain rights to both buy and sell a particular underlying asset. Terminology for this needs to differentiate between buying and selling the option contract itself. To indicate the option's rights, the terms put and call are used. This allows both terms to work in tandem to define the option and its direction. A trader can buy a put option, and they can sell a put option. Again, as with futures contracts, options can be cash or physical delivery. Options, as they are standardized, are traded on exchange, but can be traded OTC. Warrants are similar to option contracts in that they give the holder the right to buy or sell securities, but not the obligation. They also fix a price for these securities called the exercise price, similar to the strike price on an option. However, warrants differ in that they are issued only by the underlying company to which the warrant is derived from. They can be traded on an exchange, but also unregistered via OTC trading, between the issuer and buyer directly. As many warrants are privately held and not registered with an exchange, this makes tracking the price difficult. Warrants will carry a significantly longer maturity than options, years rather than months. A swap is a contractual agreement between two parties to exchange cash flows for a certain amount of time. Nothing is bought or sold. They are usually cash-settled contracts based on an underlying principal amount. This can be seen as a series of forward contracts, but at the end of the contract the underlying principal is not exchanged. The swap can be seen as a bet against a future event which one party believes will happen and the other does not. Examples of this can be the change in an exchange rate, interest rates, commodity prices, or even credit events, such as defaults. A credit default swap, or CDS, for example, is an agreement or insurance in which Party A believes Party B will default on their obligation to them. Party A would purchase a CDS from a seller that in the event of Party B defaulting, the seller would cover the cost to Party A, thus reducing risk to Party A. Party A would, however, have to pay regular premiums to the seller, regardless of if Party B defaults or not. These differ from insurance as the holder doesn't need to own the underlying covered by the contract, and the seller of the contract doesn't need to maintain specific levels of reserves to cover the contract in the event of default. By some definitions, swaps are not derivatives because there is no underlying price or rate from which their outcome are derived. However, it's common practice to include them when describing derivatives. A contract for difference, or a CFD. This is a legal contract in which two parties agree that the buyer will pay the seller of the contract the difference in price of an underlying asset at a specific date. This has the advantage that the underlying asset does not need to be purchased for the contract to mature. This negates the need to pay taxes when trading those underlying assets, such stamp duty in the UK, when trading stocks. When trading CFD contracts, they will be traded using margin, which is where the buyer will provide collateral to the counterparty to cover any open positions in the event of a default on their part. This can be in whole or partial and would be agreed between parties before undertaking the contract. These are traded OTC between the CFD broker and the client. One of the last derivative contracts I will touch on in this video is the mortgage-backed security, or MBS. This is an asset-backed security whose underlying asset is the mortgage. These are generally residential mortgages and so are technically called RMBS, but the general MBS is used. Commercial mortgage-backed securities are called CMBS. These mortgages are pooled together and packaged for sale to individuals through a process called securitization. There are two types, pass-through and collateralized. Pass-through means the mortgage payments are passed back to the contract or bond holder, collateralized mortgage obligations, or CMO. The payments are tranched or sliced into different degrees of seniority and sold as separate securities. This is to split up assets so that different investors will want to buy these new investments when originally they would not want it as a whole. Because of this, securities that may be risky can be chopped up, and it's less risky parts be given a better risk profile than the original. However, this doesn't fully remove the relationship of the tranche from the underlying asset. Mortgage-backed securities were a contributing factor in the 2007-2008 subprime financial crisis. I will cover this in a future video. That is all for this video. Please rewatch if anything is unclear. Comment if you want more information, and I will make further videos. If you want more information on why I'm making these videos, please see our mission statement in the details below. As always, look after yourself and your money, and I will see you in the next video.